Hey guys, this is Rudy coming at you live from Palm Beach in Florida. It is Monday. It is April the 29th. Where's the time gone, right? The days are just flying by, and here we are already in the big reporting season of the year. Many of the companies that we are invested in, for people following this channel, are reporting sort of, last week, this week, next week, whatever. Anyway, I'm not going to talk about climate change scams or vaccine scams or anything like that. It's a cool book. Kind of reads like a court transcript. Robert Kennedy Jr. is so accusatory in terms of his commentary on Fauci. You'd think that if Fauci actually had a defense, he would sue him for defamation or something like that, but doesn't. Anyway, I don't really want to talk about that. I want to talk about energy, right? So let me show you specifically what it is that I want to talk about. Now, of course, I've shared with you many times before what my energy portfolio looks like and what's in it. It's very diversified. For an old guy like me, diversification is key. So even within the portfolio, as you diversify across multiple sectors, in other words, you might have technology stocks and financial sector stocks and energy stocks, etc. That's part of your diversification. Within one sector, you can also diversify once more. So if you look at this little pie chart here, I've only included the sort of 85% of energy or electricity sources that matter as of 2022. In other words, I've ignored the about just less than 15% as of 2022 that don't matter. And those would be things like wind energy, solar energy, biomass, etc. So we're looking here primarily at the sort of 85, 86% that powered electricity across the world as of 2022. And of course, you can see that the major contributor is coal, filthy, dirty coal. That's why I said at the start, I don't want to talk about climate change or green energy scams or anything like that. I just want to talk about energy, right? So within the sector, not only do I hold natural gas, coal, nuclear, etc., but I also hold diversification in terms of the actual product from a point of view that it's marketing, retail, pipelines, etc., right? So there's diversification upon diversification upon diversification. I actually own quite a lot of coal. I have two different types of coal investments. One of them is metallurgical coal, which is one of my largest investments, including a company I've covered before called Colonial Coal, which is currently up for sale. You can look in the library if you want to see any of my videos that I made on Colonial Coal, including an interview with the CEO, David Austin, from about a year ago, where he explained the disposition of the company, or the intended disposition at that point in time. News in that regard is that Citibank has just signed on with Colonial Coal to help with the divestiture. So we'll see what happens there. I'm not too sure. We can't predict. We don't know. But I also hold coal, and the other coal is thermal coal, which is used for heating and for generating electricity and making steam and things like that. And that is my primary position there is Alliance Resource Limited Partners. So I'm going to talk about that one in just a minute. But let's just take a look quickly here at my holding, which is Alliance Resource Partners. It's a limited partnership, so it's not suitable for everybody. When you buy into the company, you become a partner. So at the end of the tax period, they're going to send you a K-1 if you're a U.S. tax person, and you have to include the K-1 information with your tax filing. So this is a peer comparison according to TD Ameritrade of 4 of Alliance Resource Partners as peers, and a couple of them here you might be familiar with, especially Peabody. It's one of the favorites for people who invest in coal. SM Energy has kind of been flying below the radar, but what a sweet deal this has been for people who invested in it, because you pretty much doubled your money, whereas the others have been mostly flat, with the exception of Consol, hadn't done too badly as well. Genesis Energy, Consol, Peabody, SM Energy are peers of Alliance Resource Partners. You can see they're sort of all similar in size in terms of market cap, so ranging between $1.5 billion in market cap to around almost 6 for SM Energy. So SM Energy is the larger of the bunch. They all pay a good dividend. One of the reasons why I have Alliance Resource Partners in my portfolio is pretty much just because it's a high-yielding savings account. I don't expect the stock to pop. It does from time to time when they have a good quarter like today, but then at the same time, people quite readily cash out, take some profit, and then that's the end of that. So of course, many people get in as well just before their the ex-dividend date, and then exit again once the ex-dividend date has come and gone, so that they can get a share of this juicy dividend, which is currently yielding about 70 cents per share per quarter. The PE for all of them is quite low, so 4.4 is very, very low. If you're using the PE as a benchmark to make a buying decision or not, you see Consol is even cheaper, but I'm not sure Consol is a buy. I don't know anything about Consol Energy, so I have a bit of a blind spot there. You can look if you're interested. What I'm doing here is I'm comparing these 5 stocks, and at the bottom you can follow. I've now placed them in alphabetical order. So Alliance Resources first because it starts with an A, and then BTU is the ticker symbol, but the company is called Peabody. What I'm doing here is I am taking the sales of the company and dividing it by its market cap. So it gives me a little indicator as to how the market values the company, market cap being the total number of shares outstanding multiplied by the current share price. So I'm looking at the annual sales of the company. So in this particular example here on the left-hand side, I'm looking at Alliance Resource Partners generating sales on an annual basis of around $2.5 billion, and it has a market cap of $2.7 billion. So it is generating almost 1-to-1. That's 95% if you express it as a percentage, sales divided by market cap. And then as we go to the right, you can see Peabody, 165%. Way over to the right, Genesis, 206%, and the outlier here, SM Energy, basically 41%. If it's below 100, it's an interesting outlier for me. And in this particular example here, we see SM Energy generating sales of around $2.3 billion per year, and their market cap is 5.8, right? So, but in the instance of my particular holding, my long position, Alliance Resource Partners, it's almost 1-to-1, right? So they're generating in sales almost the same as what the market values the entire company for. For the technical guys, if you look at the 20-day raw stochastic score here, Alliance Resource Partners is way above 80%. If it's above 80%, typically we can without going too deep into the weeds, we can say it's overbought. So perhaps now is not a good time to get into it. Interestingly enough, the analysts are sort of all in cahoots here on the two on the right-hand side, Genesis Energy and SM Energy, with their buy. Maybe they've been watching Jim Cramer. If you look at it on a chart, the guys who have been in SM Energy for 1 year, I don't know if any of you have ever questioned or asked me about SM Energy before. So it's relatively new to me, but maybe it's more familiar to you guys than what it is for me. So SM Energy, if you had held it over the past year, you doubled your money, right? So that's pretty good. So you're up 100% or 100% plus. CEIX, not bad at all. You've done pretty good. The other three, sort of more sort of average in terms of the performance, but do keep in mind that when you look at a stock like Alliance Resource Limited Partners, I keep the stock, as I said at the beginning, almost as a high-yielding savings account, right? I'm relying on that big, fat, juicy dividend that they pay me. So if I also get a positive uptick on the stock, so over the last year it's gone up about 10%. Add that to the dividend, which is over the past year has averaged about 12-13%. You add them together, and you're up 22%. It's not too bad for a savings account. That's a very, very high-yielding savings account. Now today, early this morning before the market opened, Alliance announced their quarterly results, and their earnings per share, $1.21, easily beat the market or analyst estimates of $1.02 by 18%. And they also posted sales of $651 million for the quarter, and the analyst estimates were 620, so they beat that by 5% too. So let's take a quick look here at Alliance Resource Partners, and then I'll wrap it up. So as I said at the beginning, it's not suitable for everybody because it is a limited partnership. If you invest in a limited partnership, you become a partner, which means it's almost like as if you've taken on an extra job. That's why you get a K-1 for tax filing, which is for US people not dissimilar to W-2, which is your earnings from your employer, or 1099, which is contract earnings or whatever. K-1 is not dissimilar to those, so you have to file that in addition. So you have more work to do come tax time. Alliance is a small cap value stock. It has a market cap of about $3 billion. Now, when I took this snapshot, it was earlier this morning, so maybe early afternoon, 12:45, and it was up over 10%. Just before I recorded this video, I looked and it was up at just over 5%. So it's basically given back $1.10 of the $2.20 that it popped with once it opened and the market saw its good results for the quarter. Anyway, as I said, a number of people will check the quarterly results, see the stock popping 10, 12% exit. And of course, if the ex-dividend date is in the past, they can also still get the dividend payment on that. Now, in this particular instance, your ex-dividend date coming up is on May the 7th. So leading up to May the 7th, you would not expect too much movement on the stock price. But once the ex-dividend date hits, expect a few people to exit, and that may cause the stock price to pull back a little bit, which might create a buying opportunity for you if you are interested in adding Alliance Resource Partners to your portfolio. Positive earnings, it's all good. Huge dividend, as I said, $2.80 at the current stock price is yielding more than 13% on an annualized basis. The PE ratio is attractive. It's sitting close to its 52-week high. On my back of the envelope, discounted cash flow math, Alliance Resource Partners is actually a stock that should be trading at about $28, $30. But at the same time, it's coal, right? And everybody tells us to hate coal, even though coal powers the world. So maybe it's tough for us to strike a bit of a balance there. From a valuation point of view, Alliance Resource seems inexpensive with a PE ratio of 4.4, as I mentioned before. Note that the two most realistic or appropriate valuation measures to use are price earnings and price to book, because of the fact that it has positive earnings. So the difference between the two is that price earnings as a ratio is TTM, it's trading 12 months, whereas price to book is MRQ, which is most recent quarter. But these numbers look pretty good, and Alliance Resource Partners seems inexpensive. So even though the stochastic is 88, it may not be a bad time to get in, but you could also wait a little bit and do one of two things. You can either buy into it now and maybe run the risk of the stock pulling back a little bit, sort of just post the ex-dividend date. But if you buy into it before the ex-dividend date, you can also get the dividend of 70 cents per share. From a profitability point of view, this company is doing an exceptionally good job. All these figures here are trailing 12 months, so TTM. Gross profit, operating profit, net profit, you can see that it's easily outperforming the industry or its peers, right? So gross profit margin almost 100% compared to 42, and so on and so on, right? So this company is doing pretty good in the greater scheme of things. In fact, Alliance Resource is one of the best at managing their owner's equity and at managing their resources compared to other companies in the oil, gas, and consumable fuels industry, right? So once again here, trailing 12 months, return on equity, assets, investment. I don't really care too much about the revenue per employee, but if you look at the numbers here, return on equity is sort of in line with its peers of the industry. But then look what happens with the return on assets is more than double the performance of its peers or the industry, and the same with the return on investment. This company is very well managed and very sound. From a financial strength point of view, come on, guys, I always look at debt, right? The debt to capital ratio at 15.36 is very low, right? Most of the oil, gas, and consumable fuels companies are more sort of in the 30 to 50% range. So 15.36 is actually relatively low. For the most recent quarter, the debt to capital ratio, 15.36 compared to the industry is almost 30, all right? So 30 itself is kind of low. It's because the price of crude has been relatively high over the last, certainly for the last few months or so, above 80 or thereabouts, which gives many of the companies an opportunity to do a little bit of balance sheet repair. Look at the quick ratio down here, most recent quarter for the quick ratio. How much cash do you have in the bank compared to how many bills you have to pay over the next 30 days or so? We want to see a number that's greater than 1. 1.7 is fantastic because the industry is below 1, which is not good. Below 1 is not only bad, but even 1 to 1 would be flying too close to the sun. So we want to see a number greater than 1, and 1.7 is pretty good. So if you use the same quick ratio and just go a little bit deeper on it, and you call it the current ratio includes cash and cash equivalents and a variety of different current assets that you can offset against current liabilities to kind of see how that ratio works. But in terms of cash, If you don't have a quick ratio that's greater than 1, you want to have interest coverage that's really, really high. And this is extraordinarily high because interest coverage for Alliance Resource for the last quarter is 44 times, whilst the industry is only at 7, right? So as that's a wrap on ugly, filthy, dirty coal, which is part of my diversified energy portfolio, and a couple of reasons why I hold Alliance Resource Partners in my portfolio, right? So coal, as I mentioned at the start, I have Alliance, which is thermal coal mostly, and royalties. And then I have colonial coal, which is metallurgical coal. And then I have pipelines, so Energy Transfer, Enbridge, natural gas, Devon Energy, Enbridge again. Enbridge is also the utility for the province of Ontario in Canada, where most Canadians live. In other words, the larger majority of the population lives in Ontario, and Enbridge is their utility partner for heating and cooling with natural gas. And of course, I have some other energy stocks as well that you are mostly familiar with, probably, if I had to say the word Occidental Petroleum, because then I can sign off as Mr. Oxy. Thanks for watching and for spending time with me. I look forward to chatting with you in the comments. Take care. Bye-bye.